On today's program, asset management expert John Siciliano breaks down the latest trends for investors. Plus, we'll take behind the explosive growth in ETFs with industry insider Nigel Brashaw. This is 7-Day Yield. Thanks for joining us. I'm Mitch Rochelle.
And I'm Haley Zimring, and let's kick the show off with some headlines. Recent research by PwC reveals 40% of today's global workforce are female, but only 5% of CEO positions are held by women. According to a CNN analysis report, only 14% of the top 5 leadership positions in the S&P 500 are held by women. These numbers reflect a very real diversity challenge facing global businesses. Well, the first quarter of 2016 saw the equity and high-yield markets nearly grind to a halt as volatility spiked due to persistent challenges to growth forecasts. Contributing factors included slumping oil prices, uncertainty around the Fed's interest rate policy, and continued concerns about China's economy. That said, in the midst of chaos, traffic has slowly been building on the IPO pipeline, leaving investors hopeful for an exciting second half of 2016. And as many businesses strive to become data-driven enterprises, countless companies are underestimating the importance of people analytics. People analytics uses snippets of people's data to derive insights about employee workplace habits and productivity. One of the most common errors companies make is having no expectations of accountability of their employees and underestimating the value of employee feedback. Using people analytics, employers can proactively use this data to power big decisions to understand their employees' needs and strategize for their businesses. And those are your headlines for today. Well, macroeconomic factors, including interest rates and an upcoming election cycle, are all playing into recent market activity. 7-Day Yield's own Gary Meltzer recently sat down with PwC Managing Director John Siciliano to discuss how these trends are impacting the asset and wealth management business.
John, thanks for joining us this morning. And it's a good opportunity to talk about what's happening in the asset and wealth management space. So maybe let's start with kind of the macro level, right? There's a lot happening from the standpoint of macroeconomic factors, interest rates. We've obviously got an election that's going to be coming. Hopefully, it can't happen soon enough, actually, but an election here and around the world. Things happening in the UK. So maybe start from your perspective how some of those macroeconomic trends are impacting the asset and wealth management business.
Thank you, Gary. It's nice to have the chance to be here today. I think what we're seeing from an institutional investor perspective is a significant disruption in the way these institutions behave. If you look at the way they behaved pre-crisis, there was much more of a singular focus around asset class investing and specific benchmark returns. Today, we've evolved into a world due to issues of global regulation, much of which isn't coordinated, pressure on returns due to a prolonged low-yielding interest rate environment, where institutions are attempting to achieve outcome investment returns versus performance or benchmark-based returns, meaning by outcome that they're investing for the intermediate to long term. And so that has caused several things to happen. A tremendous focus on non-traditional asset classes such as real estate, long-short strategies, hard assets, meaning minerals, agriculture, farmland, et cetera. In addition to which, institutions are much more careful today around manager selection. So we see an emphasis when it comes to due diligence at managers where they're looking not just at the investment process and the investment teams and maybe issues of management succession, but also they're looking at systems, compliance, risk processes, et cetera, such that they know that the manager itself has a viable business going forward.
So we hear so much about active to passive. And if you kind of came through the end of 2015 into the first quarter, and we saw some of the results with the public asset managers and the outflows. So maybe give us your perspective on kind of what are we seeing as you're seeing so much flow from active to passive investments, and what is this going to mean for the industry?
Great question, because there's 3 trends that are converging, driving investors towards passive. First of all, the long-term struggle of active to outperform passive. Second of all, global pressure on fees, whether RDR in the UK, whether the fiduciary duty rule that was just published by the Department of Labor here in the US, whether trustee concerns around fees, everything is pushing fees down, which means that if your active manager is only adequately performing and passive is roughly the same or maybe slightly better net of fees, you're going to move to passive and seek this outperformance that I was referring to earlier in the alternative strategies. So again, real estate, long, short, et cetera. And that's going to continue. And if you look at what this is doing to the investment management industry, it is really creating a two-class system, the haves and the have-nots, and the haves being the very investment-centric, high-performing firms that really have always emphasized returns over the longer period of time versus those firms that are more marketing-centric and have had strategies that were high fee but only performing adequately. And we're going to see a lot of those firms just go away.
You know, this industry's always been one that's been heavily regulated and primarily has been regulated by the SEC if you kind of look at, history. And you alluded to or mentioned the DOL, and now we have a new regulator that certainly is going to impact this industry and many different aspects of the industry, whether it's distribution, whether it's management, servicing, et cetera. So maybe a little bit in terms of your thoughts on how do we think the DOL standard might impact the asset and wealth management business as we move forward?
Well, in the U.S., as you know, we have the traditional wirehouses, which are broker-dealers that are held to a different standard than the registered investment advisors, or the FAs, which are held to a higher fiduciary standard. So in some ways, what the DOL ruling is really doing is raising the bar for the traditional broker-dealer business. And that is going to cause the final death of the commission structure and the final takeover of the fee-only business of the industry. And that is going to cause really a tremendous economic dislocation within those firms that are still operating to a large degree on the commission model. And it's going to, again, force people into products that are well-priced and well-performing. So it puts more pressure on the manager who wants to distribute through the broker-dealer or the RIA to have a top half performing product and a competitive fee. And this is going to be a long game. It's going to take a long time for this to impact and ripple through the industry. But as it does, it's one more major influencing factor on the future of the business.
And Gary Melcher joins us now. Gary, John mentioned the fiduciary duty rule. What is that?
So it's a higher level of care. So if you think about the advice that's been provided up to this point, you are making sure that investments were appropriate for your clients. Now you've stepped up to the next level, which is obviously a legal term of being a fiduciary and taking on that level of care. And that's really what we're talking about here. And that's something that other jurisdictions around the world, the UK, for example, have done also over the last couple of years.
Gary, real quickly, how nimble is the asset management business with all of this change going on?
I think, Mitch, they're improving, okay? It's not been a business where you've seen a tremendous amount of nimble behavior over the course of time, going back to the 1940s. But I think through new entrants, new products, and technology, they're becoming a lot more nimble.
Excellent. Well, we're not letting you go. We got more in store with Gary Melcher.
Great.
Want to switch gears for a minute? The ETF market currently stands at $2.1 trillion and may be poised for explosive growth. Gary recently sat down with PwC's ETF practice leader, Nigel Brashaw, on the topic. Let's take a listen.
Been a lot of talk about active ETFs, liquid alternatives in ETFs, opening up the 401k market. Kind of where do you see the ETF growth coming from?
Yeah, I think it's all of those with the exception of the 401k market. I think in smaller plans, ETFs can work, but frankly, they're not a bit of mousetrap in most of that space. When you think about what the advantages are, so lower costs, well, institutional class shares are probably lower. Intraday trading, it shouldn't matter in a 401k, obviously, for obvious reasons. And the tax advantages aren't applicable there either. So there really aren't a better mousetrap in the 401k space.
Right.
Every other space they are. A lot of the growth, frankly, is just going to be coming from retail investors, institutional investors, folks that already use ETFs. We're going to see acceleration in that space, as well as liquid alternatives, active potentially. There's things that we should probably talk about in more detail on that front. But all those places, all those.
I mean, one of the things we've talked about or we've seen on the active side has been regulatory change, proposed regulatory change. Kind of where are we with the SEC these days in terms of regulatory change with ETFs?
Perhaps before I answer that, Gary, I'm going to wind back in terms of talking about what the issue is. The issue is that the ETFs have a disadvantage when it comes to the active space because they have to publish their portfolio on a daily basis. So obviously from a giving away the secret sauce perspective, from a front-running perspective, that just doesn't work. So we see very few assets in the active space, and with the exception of bonds, because obviously those issues don't apply to that market. So that's where we are sort of from a regulatory perspective today, and that's why we don't see a lot of assets in that space. The SEC have come out. There's a number of applications that have gone in to change that. Now, obviously, there were some market events on the 24th of August, and that might delay some of those deliberations. Our view is it's a case of when and not if. So, we believe that ETFs will be put on a parallel track with mutual funds, and I think then there'll be a stable platform, and we'll see those assets in those products take off.
So you mentioned platform, right? So if you think about what's happening from a wealth management perspective, the growth of robo-advisors, kind of how do you see that playing in terms of kind of the growth of ETF assets and the access to product?
I think it's an interesting trend. When it comes to robo-advisors, and we've just spent a lot of time on the East Coast on a roadshow, on the West Coast on a roadshow, and 2 weeks in Europe. And robo-advisors is something that every large organization is talking about. And the reason, frankly, is that robo-advisors really speak to millennial investors. I think that when you look at who the providers in that space are today, there's some folks around saying that they're going to have $50, $60 billion of assets in a very short period of time. We don't view that as being the right answer. I think what you're going to see is the adoption of those tools. So if you get a chance to use some of these tools, they're quite impressive. They're obviously apps, they're obviously sort of websites. And we see some large providers that have taken on those tools and garnered a lot of assets. I think that's where the future is. It's not in those smaller providers, it's in larger shops taking the tools on and really sort of using those. I think it's important today. I think it's going to be critical in 10 years' time. If you don't have a robo-advisor offering, it's going to be difficult to compete, especially with those millennial investors.
I mean, as we get through, we're a couple of weeks before the end of the year, we see some of the performance information coming through on what's happened in the markets. Active investing actually has been, very, very positive in terms of result. It's been a troubled year really on the hedge fund and alternative side. Kind of how do you see, the active market vis-a-vis the ETF and passive market as we go into 2016 and beyond?
I've got no idea, Gary, and frankly, neither does anyone else. My sort of personal view is I'm not an active investor. I think the ETFs, obviously, at the moment, are very passive products. But what's important for people to realize is they're already used in active ways. So hedge funds use a very significant amount of ETFs. We're going to see that continue, and that's part of the growth strategy, I think.
Great.
That's clearly going to continue. But I think that what people need to sort of focus on is sort of where ETFs play strongly, and that's clearly in the passive space. We've seen a lot of growth in that space over a number of years, and that rising tide has lifted AUM in ETFs, there's no question about that.
Great. Thanks, Nigel. I mean, a lot to think about as we get into 2016. Thanks for giving us that current update on where we are from an ETF standpoint.
Happy to.
So, Gary, hedge funds actually use ETFs as well?
Yes. I mean, hedge funds have always been a very big user of ETFs. It's a very effective and efficient hedge. So that's effectively how they're using the products as they look at the markets. And because of the size of some of those funds and the use of ETFs, they do have a significant influence on market activity over the course of time, and certainly from a day-to-day basis, without question.
And the fact that ETFs are bought and sold by hedge funds, how does that impact me as a retail investor?
It doesn't necessarily impact you. It impacts more the market because, as I said, they can really move the market based upon the level of activity. I think that the push certainly is to increase the usage of ETFs across the retail space because of the ease and tax efficiency and the fee structure, et cetera, but not really a direct impact other than, as I said, the market activity.
Well, Gary, thank you so much for joining us. On our next episode, new regulations are coming out of the Department of Labor. They're changing the rules of asset and wealth management. We'll dig into that and more next time on 7 Day Yield.